On April 7th, Donald Trump announced a Middle East ceasefire. When the markets opened the next morning, they reacted with a violent upward explosion. The S&P 500 closed up 2.5%. The Nasdaq jumped nearly 3%. The Dow climbed more than 1,300 points, marking its best day in almost a year. Traditional financial media immediately blanketed the airwaves, celebrating this as a massive relief rally driven by global optimism. But within a matter of weeks, the ceasefire had completely dissolved in real time. The geopolitical situation was deteriorating, yet the stock market remained pinned at all-time record highs. Looking at this satellite view of the Strait of Hormuz, the maritime data tells the real story. AI-driven intelligence tracking GPS signals detected a 96% decrease in shipping traffic. Only 5 outbound carriers were moving. There was absolutely no peace on the ground. If there was no peace, the market didn't rally on world peace. An unseen, entirely mechanical force overrode geopolitical reality. We're taught investing is a human endeavor. Analysts read global news, evaluate company cash flows, and then manually adjust stock prices based on logical findings. But look at the weeks leading up to April. A high-profile military strike killed Iran's supreme leader, and Wall Street panicked. Analysts projected global supply chains would snap. They modeled oil rocketing to $300 a barrel and stocks at the fastest pace in 13 years. The traditional market, driven by human logic, is dead. To understand why stocks shot upward in the middle of a conflict, we must stop looking at human emotion and start looking at the machines. Today, these funds operate on a system called market cap weighting. When new capital flows into the index, it doesn't get distributed evenly, and it doesn't get distributed based on a company's merits. It is allocated proportionally based on a company's existing size. The bigger the company, the more blind capital it receives. Because of this automatic funneling, just 7 massive tech companies have absorbed so much capital that they now make up over 35% of the entire S&P 500. This creates an incredibly top-heavy structure. Massive chunks of the market receive funding by default, completely bypassing earnings reports, fundamentals, or human oversight. This passive foundation created a tightly wound, fragile environment heading into April. It was perfectly primed for a mechanical chain reaction. That chain reaction started on the evening of April 7th with the ceasefire announcement. Going into that night, hedge funds had taken on near-record leverage. They were sitting on massive short positions, betting heavily that the market would continue to drop amid the escalating tension. When the ceasefire news hit, it caused a tiny upward bump in stock prices. That small bump was enough to trigger margin calls, automated demands from brokers requiring these over-leveraged funds to deposit more cash or close their positions immediately. To close a short position, you are legally forced to buy back the borrowed shares. All of these funds buying at the exact same time pushed the price even higher, which triggered even more margin calls. So when the opening bell rang and stocks exploded, it was not human investors celebrating world peace. It was trapped hedge funds panic buying simply to survive. That initial squeeze knocked over the second domino, commodity trading advisors, or CTAs. These are massive, rules-based algorithmic trading models. They do not care about geopolitical news. They strictly follow mathematical price trends. When the short squeeze pushed the S&P 500 past specific mathematical thresholds, these algorithms systematically flipped. Their internal coding dictated an immediate shift from holding short positions to aggressively going long. The trading data shows these algorithms automatically purchased $86 billion in equities over just 5 trading sessions. They executed these buys completely blind to the failing ceasefire on the ground. This massive influx of buying triggered the final domino. On the other side of every options trade is a dealer who is mathematically required to keep their books balanced as prices move. As algorithmic volume exploded and prices ripped upward, these options dealers were forced to buy massive amounts of the underlying stocks simply to hedge their own risk. A short squeeze, blind algorithmic trend following, and forced dealer hedging stacked on top of one another. Together, they formed an artificial feedback loop that drove the market to all-time highs, completely ignoring the geopolitical reality. Recognizing this mechanical stacking is the only way to make sense of a market that hits record highs while global crises unfold. It explains exactly why certain AI and tech stocks currently trade at completely irrational multiples, anywhere from 47 to 400 times their actual earnings. The blind momentum of passive indexing and algorithmic buying drags the entire tech sector upward, pulling the broader index with it. The April rally was not a one-off anomaly. We see these exact same structural flash spikes and crashes play out repeatedly, acting completely independently of underlying economic health. Fundamental metrics and logical human valuation no longer dictate short-term price movements. The stock market is now an arena of algorithms and mechanical roles, reacting strictly to the movements of other machines. This creates a highly dangerous environment, a long, choppy, sideways market. In this space, algorithms violently rotate capital back and forth between asset classes, creating massive swings without any clear long-term direction. Trying to trade based on traditional news media headlines is a trap. Those headlines are just the stories human beings invent to rationalize the algorithmic math happening beneath the surface. Anyone claiming they can predict the market's exact next move by pointing to an earnings report or a piece of economic data is likely lying to you. To survive the modern stock market, you have to discard the traditional human narratives. Understand the mechanical feedback loops actually driving the tape, expect the irrational, and above all, practice extreme patience. Let's talk about the bedrock